Welcome to Real Estate with Harmony. My name is Sandra Zeman. I'm the owner-broker of Harmony Real Estate. Today we're going to be talking about the real estate process, basically the loan end of it, if you will. And our special guest today is Justin Macagba from Envoy Mortgage Company.
Yes.
So Justin, empty your head out, your brain right here on the floor, and tell us everything you know in 30 seconds.
Yeah, we'll be here for a while if that was the case.
Tell us about yourself and how you came to get into the mortgage business.
Sure. Well, thank you for having me on the show. I definitely do appreciate it. I am originally from Rhode Island. I ended up moving up here from Warwick about 7 years ago and have been in banking and finance ever since then.
But how did you come to choose banking and finance? For instance, was math your strength, and therefore, well, because math, when I think of finance, I think of math. I think of numbers.
Right. I originally went to school I have a double bachelor's in accounting and business management, so it was just a natural progression.
Wow.
And actually, I ended up getting into banking and finance by way of I used to be a waiter at the Outback Steakhouse, and one of my regulars. That's when you made the
big money, right?
Yeah, exactly. That was the easy money. But one of my regulars offered me a job to come in and be an assistant to the office as a for all the more.
So you were learning, mentoring.
Absolutely.
That's the best way. I think that's the best way because it's hands-on learning. It's
Absolutely.
Always better than book learning. At least for me, it is.
Right.
I'm not much of a bookworm though, so that would be. So have you found? You have found it to be rewarding, and it's the career. Well, so in that light, today I would like to try to share with the public some of the difficulties of getting a mortgage loan, because the process, I think, has become cumbersome. Most people, when they think of a mortgage today, I think they think headache.
Right.
Well, I always say they lock the door after the horse got away.
Sure.
But is that your take on? It seems to me that when we were back in the good market, they were allowing things to happen that should not have happened.
Right.
And so now we're paying a penalty for that, and they're being much more stricter, much more. So can you share with us some of that, some of the changes that came about because of that market?
Well, when I first got in as the assistant, we were just talking about, that's when it was the quote-unquote good market, and there were things that were happening that more than likely shouldn't have been happening. It was always the breath test. If you can fog up a mirror, you could get a mortgage, and that just is not the case anymore, because obviously we are where we have been.
I remember the thing that I disliked most back in that market was they had this one loan that if you had a certain down payment, you didn't have to verify your income then. You could just say, I make $200,000 a year, and they didn't challenge it. They didn't question it.
Right.
I think of that as the worst loan that they had, and the one that caused us the most problem. But now maybe being in the industry, that was not, from your perspective, the worst. There probably were a lot of offenses.
There was a lot of that happening at the time. But what we can say for certainty now is that those programs just don't exist anymore. Because let's face it, if you're stating your income and you know you need to state a certain number in order to get into the home of your dreams, you're setting yourself up for failure. And a lot of times we found that people were going out, looking at houses, falling absolutely head over heels in love with them, and doing whatever it takes to get their entire family into their dream home. Now that is essentially gone.
I can remember in real estate, because I'm in real estate, I can relate to what you're saying, because I remember people coming in and wanting to look at what I knew was beyond their qualifications, not only beyond their qualifications, but I tell people, don't think so much about what they will approve you for. Think about your budget. Think about after you pay for your lights and your heat and your whatever your expenses are for them, how much do you have left over? Because if you don't have enough, something's going to have to go. And I find that, I like to stay underneath the ratios. And that was one of the things I wanted you to share with the audience. When you think about acceptable ratios of a percentage of your income that can go for housing and a percentage that can go for your credit, what are the percentages that you, not the loans you offer, but you see as being realistic percentages?
Right. You're probably talking about, so we look at two different sets of ratios. We look at the housing ratio, and then we look at your total debt to income ratio. The housing ratio is how much you make versus how much your monthly mortgage payment is going to be, including your principal, interest, taxes, and homeowner's insurance. The back ratio is all of your existing debt that is showing up on your credit report plus that housing debt in order to come up with a number which would be your total debt to income ratio. I typically like to see for a strong borrower 29% on the front, which would mean 29% of your income can go towards a housing payment. On the back end, you have 45%. That would be all of your existing debt plus that housing expense weighed against your existing income.
So to make it very easy for the public, if they make $1,000 a month, $290 a month is what is approximately where they should be for the house payment.
Right.
And including, if I included my debts in that, it should be no more than $450 or 45% of my total income. I think when I used to qualify people, one of the things that they never understood whether that was before or after taxes.
Sure.
So we're talking on gross, correct?
Gross, not net, so before taxes.
Right. So it's before taxes. So if you take what you make, not how much you bring home.
Right.
That's where people get confused, I think. So just so the public will be completely understanding. I always give people, I used to say to them, if it costs $7 a thousand, now you can very easily on your own figure out a payment for any house.
Sure.
So what is that approximate cost right now per thousand that they borrow on a 30-year mortgage?
30-year mortgage, it's going to depend on the type of financing they go for. So you have your conventional financing, you do have FHA financing, you do have rural housing. There's a whole wide range. So
what's your average?
I would still, for a conservative number, I would probably still use that $7, $6 just to set a realistic, a conservative number.
So if they were going to borrow $100,000, $7 per thousand would make it $700.
Right.
And then they would have to add their taxes and their insurance.
Right.
And then they would go back to this formula of 29%.
29 to 45,
and so they
absolutely.
Would pretty much they could triple that, and if they made that amount of money, they would be in the running, shall we say? Let's not let the horse get out of the gate.
Right, right. So. No, and there's obviously a lot that goes into that, but it's a good benchmark to use when you're trying to calculate what works and what doesn't work. One of the tools that I do have my own mobile app, and it will allow for you to calculate payments on the spot with the different types of mortgage.
On your website?
On my website, it can definitely direct you to that app.
So can your client go to that website and do it for themselves?
If they go to my website, if they shoot me an email, which will be on my website, they can get access to the mobile app.
And I think that the show is going to put your email under your name today, so that, or not your website.
Right.
I think of it as cumulative, actually, because if you get to the website, you've got
everything.
You're going to find me.
Everything
is there, yes. Well, and
you can't hide in today's.
And I bet if they put Envoy, they could come up with. They would get to you easily as well. So I find that I can't get away from myself. Everybody knows who I am.
Right,
so,
right.
And I love it. I do rentals. I have property that I rent myself.
Sure.
And I love it because I can Google a name. And I can say John Smith, and it's going to tell me all about John Smith.
Yeah.
And you wouldn't believe how many tenants. I mean, I remember one that it came up that they were felons, that they were they were crooks. And I said, thank you, Lord.
Right, right.
I didn't want that one.
Right.
So it's really a good thing. The bad thing is, though, that we are in an age where there is no privacy. Privacy is, as a politician, that's something that I concern myself about all the time. But that's another story that we can have on another show.
Right.
So let's continue then. I would love to finish the show by having people have a sense of exactly what this process includes, because it is cumbersome. So one of the things that I hear people very concerned about is credit. When I was young, I had terrible credit. Now that I'm old, they beg me to borrow money when I don't need any money anymore. And then that's the way of life, is it not? When you're young, you're struggling because you're raising your family. You've got that house payment. But what goes to a credit score, right? And so the minimum credit score and then the maximum, and does it make any difference? Like if I have a 700 score, does that get me a better interest rate?
Absolutely.
It does.
Absolutely.
So take care of that credit score, folks.
Absolutely, yes.
Because what used to drive me crazy, I can remember I had clients who wrote the contract, and we got a week before closing, and they went out and bought a new car, and it knocked their ratios completely, and couldn't buy the house anymore.
Right.
And I said, why did you do that?
Right.
You've killed us. And that happens. So I tell people, in this time frame, by the time you sign the P&S until you close, please don't buy anything. Stay
Right.
at home, watch TV, and have
Right.
Kool-Aid and cookies. So, because it literally will, going back to the 45% ratio, a car payment today, it's not unusual to have $400 or $500 car payment.
Right.
So that,
Right.
of course, will knock you right out. So tell me the minimum credit
Right.
that they can have.
Minimum credit is going to vary lender by lender. So FHA as a whole will lend down to 580, but it's whether the lender itself is going to allow for that to happen or not per their guidelines. So if you can go to one place to another, guidelines are going to change. But you typically want to, you have access to be able to pull your own credit report to make sure everything is showing up accurately, which I highly encourage people to do on a yearly basis to make sure they haven't become victims of identity fraud or, yeah, it's probably one of the, exactly.
It's a
and to come back from it, it's
a nightmare.
pretty
Every
difficult.
time I order something on the internet, I get anxious. I ordered some makeup last week, and I have to say, I said to myself, so they're going to steal my credit card number, and the first thing you know, I won't have any credit because they will have muckied it up pretty bad. So it is of concern today, keeping it's of concern. So go back, and so we're talking about the minimum credit score and the maximum. So we're saying 580 to...
Again, each lender is going to be different, but...
So, that's what I wanted. So for the public's sake, I want them to think about this. You don't have just one approving authority anymore. In the process, there are really three, right? The first one would be the originator, which would be yourself taking the loan. The second one, there's an underwriter.
There is, so the way that the behind the scenes work is typically you have the loan originator, which my position is to originate the loan, inform the public about what their options are when it comes to home financing. Then you have a processor. The processor is really the person that reaches out to the customer and is gathering the necessary information that they need.
Documentation.
Exactly.
Paper,
and that is,
paper.
That's probably one of the biggest frustrations that people have is when it comes to documentation is because you can supply us with the necessary information, 2 months bank statements, 2 years W-2s, most recent pay stubs. You can supply us with all that information, but an underwriter, which we'll talk about in a minute, is going to look at that documentation and ask for additional documentation on top of that. So if there's anything that you can inform the public about, there is a lot of documentation that is going to be required throughout the process. So large deposits, for instance. If it's normal for you to make $2,000 on a monthly basis and all of a sudden there's a $5,000 cash deposit showing up in your bank account, an underwriter is going to question it. They want to make sure that it's not coming from, maybe it's a loan that is not showing up on your credit report. Maybe it's money that you owe to somebody else.
So what about a gift? Can they not get a gift like from Mama and Daddy?
They can get a gift.
My kids all did. They're still getting them.
Well, mine are 6 and 2. Their version of a gift is a video game or a doll. So.
It'll get worse, I promise.
Oh, it has.
It's expensive, but it's worth it in the long run.
Oh, absolutely. And you can do a gift. And again, just as long as it's documented. So there's a gift letter that the person How much
can they get? Is there a limit on the gift?
There really isn't a limit. If anything, that's something you want to consult with your originator
So Mother and Daddy
about.
could give them the whole down payment?
They could give them the whole down payment, absolutely.
They could.
Absolutely. And in certain cases, that is usually with conventional financing, you usually will see that. With any type of financing, really, you can have the down payment gifted to you. There are additional documentation that comes with that, because again, we are paper trailing it. We need to know where it came from. So
you need to verify everything. Verify,
exactly.
verify, and verify. So
absolutely.
Yeah, and it does become a nightmare of paperwork. And I always concern myself about a choke at the end, because at the end, and everything always happens at the end.
Right.
Just you're a week from closing, your time to be approved, get that approval date accomplished, and now all of a sudden, you know, the garage next door is in the middle of your I remember there was a garage that was in the middle of 2 lots.
Sure.
So that they had to cut the garage in half in order to,
wow.
And I don't know how something like that happens, but
right.
it does happen.
It does happen.
And of course when that happens, you can't close until that's resolved.
Exactly.
So, and that's not the only issue. There may be an issue with this verification of the down payment.
Sure.
They may challenge it for some reason. They may question it. all kind of things come up at the last minute, but people are so stressed out. And when
Right.
it happens at the last minute, that's where a good realtor holding hands is such a well, because people are anxious. It's
Sure.
it's the largest purchase that the average person ever makes.
Absolutely.
And so that's why I tell people the real key to anything is finding people you trust.
Absolutely.
Find somebody who's trustworthy and then stay with them forever.
Mm-hmm.
Because if you found a good one, then
Hold on tight.
So what is it they say? You always get the other kind. So I tell people, work with the people you trust, because
Right.
and the comfort level is so much higher
Mm-hmm.
when that happens. And I think that the stress, because it's a very stressful.
It is very
Very
stressful.
stressful process. So, well, especially because they have to have given their notice.
Mm-hmm.
So they've given their notice, and now they find out that there's going to be a 3-week delay.
Mm-hmm.
The people who are coming into their house are not going to let them delay. So now
Right.
they have to put their furniture in a truck and sit and wait the 3 weeks in a hotel or at mom and daddy's or something. It can be a nightmare.
Right.
And so a couple of other little things. I've had people come in and say to me, well, I'm on Social Security. I don't have to pay any taxes. Doesn't that make me a little better? How does that make them a little more qualified? What is the advantage there?
There is, when you're collecting Social Security income, whether it's due to retirement or disability, if you are not, you'll get a Social Security award letter, and every year you get a statement showing how much you would have received from Social Security. If you're not paying taxes on it, with certain loan programs, you have the ability to gross up that income by 25%. So you're receiving X, you can take that number, multiply it by...
So they're taking the average amount that people pay in taxes and giving it back.
Exactly.
For qualifying purposes.
Exactly.
Well, and that's a good thing, because sometimes that can make the difference in... Sometimes it can make the difference in qualifying and in not qualifying. Although in the olden days, of course, the least expensive house you could get was over $200,000. Now, of course, our market has changed so dramatically that indeed you can get in for much less. Somebody just recently bought a condo from me, and it was $50,000.
Wow.
Do you know how long it's been? I mean, in the old days, $50,000 just wouldn't get you in. It would not get you in the door anywhere for anything at all. So what about self-employed? I think that's another difficult. That can add cumbersome paperwork, can it not?
It can increase the amount of paperwork that you receive, and it all depends on how you hold ownership to your business. So a lot of times, if you're filing your tax returns, you Schedule C, or it's an S Corp, or whatever the case may be, when you're self-employed and you're looking to get qualified or pre-approved for the purchase of your next home, you just want to be certain that you have 2 years running history as being self-employed. 2 years.
And they average it?
So what they end up doing is, and they being underwriters, will take the average of the 2 years. Now, one important thing to note, you want to make sure that it's not declining income from 1 year to the next, because that's obviously a negative in the eyes of an underwriter.
So are we saying in reality, if I made $200,000 this year or 2 years ago, but this year I only made $150,000, that's a declining.
That's declining income.
This year I made less than last year, so now we're going to come under the microscope because it looks like maybe things are going the wrong way,
That's
and
exactly
is it going to
it.
go worse?
Right.
So it could be a loss for the lender, which of
Right.
course they're trying to avoid. So in a case like that, they probably would just not approve it.
They would want additional documentation or reasoning as to why there was a year-over-year decline. It could very well end up where the loan doesn't come together as a result of that declining income, but if there are compensating factors as to why there was that year-over-year, there's a chance it may work, but
so
again,
for instance, if the company put a lot of money into capital improvements, that might say to them, well, the business didn't really do less, but they spent more on the business, putting money back in. See, I always tell myself, if I put 10 in this year, but next year I get 20 out, I'll put 10 all day.
Right. No, absolutely, absolutely.
So,
and I think in our respective businesses, it's it's almost like standing in front of an ATM machine. You need to put $20 in order to get $100 out. Same thing with businesses, which I get. But there are things that we can add back into the overall equation. But when it comes to being self-employed, you just want to be sure that you're getting your ducks in a row before you even step foot into a house you're interested in purchasing, because there's just a lot more that goes into that overall equation of what we can use for our income.
See, I think a good realtor makes a good realtor insists that you pre-qualify first, not because they're aggressive and want to be in control. That was never the issue for me.
Right.
The issue for me was, if I take you, I think you said it earlier, if I take you out and you fall in love with this house and you've moved your in your mind, you've moved the furniture in, you've got the baby.
You've already assigned the rooms.
All the furniture is in place, and now I have to say to you, gosh, I'm sorry,
Right.
you have to come down $15,000 to qualify.
Right.
Then it's very disheartening, and it's demoralizing. It's just absolutely demoralizing. So I always tell people, please don't do that to yourself or to me, because you'll think it was my fault. And to some extent it will be if I let you look at something you can't afford.
Sure.
So I always try. And finally, one last thing that I think is important is closing costs. I arbitrarily use this, well, I don't know if arbitrary is the right word, but I usually tell myself 6% of the cost. So if it's a $100,000 house, closing costs can be like $6,000. Is that still a standard?
You're not the first person I've heard use that same calculation, and I guess it depends on a variety of different things, but you can still use that 6% as a good gauge. But touching on closing costs, a lot of people have the misconception of closing cost equaling cash to close, or equaling cash to close, where there are so many things that go into the money.
So you're saying there are two sides of the money that you have to have. One is the down payment, and one is the closing cost, and cumulatively that's the total figure. But I always tell people, if you get the right loan, some of those closing costs can be paid by the seller.
Absolutely.
For instance, if they were going to negotiate, instead of asking them to negotiate, you ask them to pay part of that closing cost.
Sure.
And I think FHA is where you can have 6% paid. Is that still the case?
That is still the case.
So if you were cash strapped, so then what are we saying is the minimum percentage that a person would have to even consider purchasing a home?
It's going to vary case by case. So for instance, like VA financing, if you're a vet.
No money down,
No money down, but what that doesn't include is the closing costs as well as an establishing of an escrow account. So taxes and homeowners insurance can continue to be paid in your overall payment on a monthly basis. So that's where you can negotiate the seller paying for some of those costs. But it all is going to ride on.
Can they pay, if 6% covered all of those costs, they could pay them? There's nothing there that VA won't allow to be paid by the seller?
The only item, there are certain items that cannot be paid for by the seller or by the buyer. I was actually having a conversation earlier today, and one of the things that's required in Hillsborough County is a pest inspection. Well,
that didn't used to be required. That used to be optional.
Right now it's for VA financing in particular. They require that a pest inspection is done.
See, that's part of closing the gate after the horse got and there are a lot of, I think there are a lot of examples of that, closing the gate after the horse. That's interesting though. So you don't have a figure that would, I used to, probably wrongfully so, but I used to tell people, if you don't have at least 3% of your own money, then I think you need to wait and try to save. So if it was $100,000, again, $3,000. So would you say that's still accurate? You're looking at me
I would probably bump that up a bit to the 5 or 6%.
To 5 or 6%.
Absolutely, to take care of not only the down payment, should there be one, depending on the loan that you're applying for, but also being able to cover some of those closing cost prepaids as well as reserves. It's always good to have some money set aside for, let's face it, you're purchasing a home. You've done a home inspection, you've gone through and you've identified, what needs to be worked on or what doesn't need to be worked on, but that doesn't mean that the furnace is going to go the next day.
Sometimes the house is another child. I think of a child as being very expensive.
Oh, yes.
And houses can be very expensive because to protect your investment, you really need to take care of the house, and that means money. You have to paint it periodically. You have to change fixtures, heat, gas, whatever it happens to be. There's always something that needs to be taken care of. Just like a child, there's always care.
Well, all the major appliances in the house have a certain shelf life, just like a car.
Good point.
You're supposed to have your timing belt replaced every 75,000 miles. Same thing with the furnace, same thing with...
Roof.
Exactly.
Roof.
So those are additional costs that you should absolutely take into consideration when purchasing a home, as well as having set aside in the case something should happen. because life will throw curveballs at you and things will happen. So I usually, if I'm working with borrowers and I see they have a money fund for the house and then they have an emergency savings account.
It's good planning.
Great planning.
It is good planning, but I don't see that. I haven't seen that as a realtor very often. They don't. Most people, it takes every nickel they have just to get through the door.
Right.
Just to get through the door. But if mama and dad, again, going back to if you have somebody that's willing to help you out, that's one thing. And there's all kinds of things our time is giving up. But we could talk about two families, because obviously they count the income from some of the rental property, and so that would encourage your qualifications to a higher.
That would make a difference.
Mobile homes, leased land. There are all kinds of ways to get to a lesser. I tell people, just get started, because it has been, at least for the most part in this country, that after you get in, your equity increases. You know, you improve the house, it gets more expensive. Now, of course, in this market, that has not been the case. We still have a lot of upside down loans where people owe more than the house will sell for now.
Right.
But hopefully we're coming out of that. Hopefully we're headed up the mountain to the sunset, to the sunshine, and to the land of plenty. Well, Justin, thank you so much. Is there anything you'd like to share with the public before we?
If anything, you know, when you're going through when you're considering purchasing a home, probably one of the smartest things you can do is to start to gather the paperwork that an originator is going to ask you for, and really sit down with that person to identify where you're looking to be as far as monthly payment and cash to close. The best thing you can do is to be prepared so that when you are out there looking at homes, you have a realistic number in your head as far as what you're looking to purchase. So being prepared is probably one of the best pieces of advice I could give when looking to purchase a home.
Well, I think that Justin's information is on the screen, and I hope that if people have questions or comments or anything they like to discuss with you, they'll give you a call. Go to your website. I always love the websites. They are a blessing.
Absolutely.
There are good things and bad things with this age of information, and that's one of the good things. But thank you so much for coming in, and I hope you'll come back and we'll expand on these. These have been very elementary parameters that we've tried to give the public an idea. But maybe you can come back sometimes and we'll get into the nitty-gritty.
We'll get into the nitty-gritty.
We'll get into the real hard stuff. And in the meantime, thank you again. And thank you all for watching the show and joining us today. And we hope to see you again real soon on Real Estate with Harmony. Thank you.